Hi, everyone. In this lecture, we're going to talk about why profit does not equal cash. Well, why does profit not equal cash? Well, because of the accrual system, that's one reason why profit does not equal cash. So at the end of the day, if we were looking at Netflix's bank account, their net income showed $2.7 billion. Well, does that mean what they have in the bank account? No, not necessarily. And remember that depreciation, because it's a non-cash expenditure and it's an estimate on the lifespan of the equipment, it affects the company's profits, but not its cash flow. The actual cash that a company has is represented on the balance sheet as a current asset. Okay, so here I'm going to give you an example to put all of those words into action. So in this scenario, you have a business and you create websites. So you have $15,000 in cash to start your business. Okay, now we're going to make some assumptions. You're going to sell each of the websites that you create for $5,000. Your cost of goods sold is 55%. Your cost of goods sold in this situation would be the labor involved, maybe the software that's involved in making and creating those websites. And then you've got monthly operating expenses of $15,000. And the operating expenses would be, let's say, if you have someone sitting at a front desk answering phones, that person's not directly involved with creating the website. So that's where their expenses would show. If you're purchasing supplies for your business, if you're paying the rent and the utility bills, those are not involved in making the website. So therefore they would go under monthly operating expenses. So in this scenario, you're creating these websites at $15,000 each, and we've laid out the assumptions. And in January, you have sold 5 websites. And in February, 10 websites, and in March, you've sold 15. So let's see what each month looks like. So in January, if I sold 5 websites at $5,000, my sales are $25,000. So my COGS, my cost of goods sold, is 55% of that. And that comes out to $13,750. So that's a gross profit of $11,250. Except I have to remember that I have these monthly operating expenses every month that equate to $15,000. So at the end of the day, I'm at a loss of $3,750. But then in February, I increased my sales, right, to 10 websites worth $50,000, but my cost of goods sold also increases because it's 55% of my sales, and my expenses remain the same at $15,000, and I come to a net profit of $7,500. And in March, I sell 15 websites, and I'm now profitable with $18,750. But what really happens with all of the cash with this? Okay, so in January, you have, it says 10,000 on the screen, but you have 15,000 in cash. Remember, that's what you started your business with. And you have $25,000 in sales, but the customers haven't paid you yet because your payment terms are net 60 days, which means I've created your website for you and I say to you, here's a bill, and it has to be paid within 60 days. And for costs of goods sold, those are the vendor costs, right, used to create these websites. And those payment terms are net 30 days. So whatever my costs of goods sold are for January, I don't have to pay them until February, right? Now, the operating costs, no matter what, whether I brought a penny into the business or not, you still have to pay those expenses to keep the business running. You have to pay your rent, you have to pay your utility bills, you have to pay, your phone bills. So now the $15,000 that you started with is gone, because you have to pay out expenses to run the business. So let's take a look at that. So you started with $15,000 in cash, and your operating expenses are $15,000. So now you end up with zero. Well, what about the $25,000 that I, of product that I sold to my customers? Well, yes, you did sell them, but they haven't paid you yet, right? So you don't have that cash in your pocket. So what happens in February? You don't have any cash in the bank because in January you went through that $15,000. You still have not collected the revenue from the sales you made in January because it's net 60, which would mean 2 months. And you haven't collected the sales from February because again, it's net 60. But now you have to pay for cost of goods sold because the net payment of 30 days from your cost of goods sold in January now have to be paid in February. So looking at this screen, you can see in February, I don't have any cash on hand. My cost of goods sold expenses are now $13,750, and those were the costs from January. My expenses remain the same at $15,000. So now I'm in the hole for $28,750. And now in March, right, if you look at February, you have a negative cash balance of $28,750. Now you will receive the cash from the January sales in March, $25,000, right? Because we said the customer has to pay for the website in 60 days. And you have to pay for your cost of goods sold from February in March because that was net 30. And you have to pay for the expenses to keep the business running, and that's $15,000. So now it's in March. Now I'm down $17,500. So this provides you an example of why profit does not equal cash. Right, so we've got this accrual system in place where we're matching revenue and expenses. We've got depreciation thrown in there, which shows, a certain dollar amount for the lifespan, not an actual amount, and even the lifespan in itself is an estimate. So when a company talks about being profitable, it doesn't necessarily mean that they have cash in the bank. And the slides that we just went through shows how that can be. So, a profitable company looks great, but you're really interested in the cash. They're both very important. Investors probably, and investors and stakeholders and stockholders want to see a profit. But more importantly, you want to make sure that you have the cash to keep the business flowing. Talk to you soon.